Hey guys, happy Friday, and today the market pulled back about 1%. And in today's video, I want to go ahead and cover three main subjects. First off, we're going to go over the market downturn today, that 1% pullback, the reasoning I think caused it, and also some rotation I may be seeing, and just kind of analyzing that, because as you can see, there's a lot of red, but there's also a lot of green. Could be a signal of something there. The second thing I'm going to cover is I'm just going to briefly go over what I personally was buying this week. And then finally, we're going to end off the video with me kind of going into some new opportunities I'm seeing and that I'm planning to do more research on. And these are potential positions I may be adding to my portfolio. So first off, starting off, I got the heat map pulled up right here. So as you can see, there was a lot of weakness in more of the technology and a lot of the names that have been more high flyers. Stuff like the NVIDIAs, Microns, AMDs, Intel as well. So a lot of these more chip player names that have been pumping kind of hard in the last month, those have got hit pretty hard. As you can see, NVIDIA down 4.4%, AMD down 5.6%, Intel down 6%, MU down a whole 6.6%. But if you notice, this is why I'm thinking there may be a rotation going on, is if you kind of zoom in onto where there's a lot of green, it's in a lot of these software plays. So we're seeing Adobe up 4.4%. CRM up 3.5%, and ServiceNow up about 5%, AppLovin 3.2%, and you can kind of see right there. Now, these names have been doing kind of poorly over the last year, I'd say, and it's just been really part of this whole SaaS apocalypse thing going on, where a lot of these SaaS companies have been having their stock price hit a lot because a lot of people think that AI is going to basically come in and just completely destroy their business models, which I personally don't see happening. I don't believe that's going to happen, but regardless of that, let's start with market. Main thing it was down on is that the bond yields were up. So this is something to understand, like kind of the relationship between bonds and stock markets. It's when bond yields are rising, stock prices tend to go lower. The way you can think of that on simple terms is, let's say I can go get a treasury that's paying me 5.5% and the market on average is giving me a 9% return or an 8%. A lot of people will look at that and say, okay, what I want to go risk my money in the market for that extra 3% when over here, the treasury, which are seen as risk-free, they're backed by the government, I can just go park my money over here and earn this 5.5% or whatever the percent for the risk-free rate is. So the higher that percent goes, the lower stocks are going to go, because people are going to be willing to pay less for stocks because it's higher risk. You got this return over here that's risk-free, and you can get a higher and higher return. When those bond yields are lower, like let's say if the bond yields right now, we're only paying like 1.5%, 2%, and you still have the market averaging like 8, 9%, okay, then people say there's a big enough spread to where, yeah, let me allocate more of my money into stocks. And that's the main basic concept with that, if you were wondering. Now, if we come in and look at some of these names like we're talking about, so as we already kind of showed, the ones that got hit today were a lot of those chip companies. But if we look at some of the SaaS companies that were up pretty strong today, like ServiceNow at a 5% gain on the day, which is pretty big. If we look year to date, though, down 37%, on a 1 year down 54%. These SaaS names have been really hated as of recently, and they've been getting just decimated. If we look over here, if we come over to a CRM, a Salesforce, we'll see kind of the same thing. So if we're looking at down 34% on the day, it was up 3.5%. Another strong day right there. If we're looking on the 1 year, down 40%. So a lot of these SaaS names, especially Adobe, this is one I actually do have a position in. This one I started buying probably around like the 290 range, I want to say, is when I started stepping into this one. But anyways, yeah, year to date down 30%, 1 year down 40%. Just these stocks have been getting decimated. And this one, as you can see, a 4.47% move. And keep in mind, with a lot of these names, their market caps are pretty large. Like, that's $100 billion market cap. To move that 4.4%, that's a lot of money flowing in. And same thing if you're looking at like the ServiceNow and the CRM. Let's go ahead and pull those back up real quick. Yeah, I can say about 100 billion on that one as well. And CRM, we can look at CRM over here, sitting at 140. So the larger the market cap, obviously that's going to need a lot more money to push it up, which is why whenever I'm looking at this heat map, I'm thinking, okay, this might be just a rotation of money where managers are just moving monies and pulling it from these chip names that have been running and starting to allocate over here into the software names. Because when you're selling over here, there's going to be buying that takes place. Whenever these positions are getting cut, there's rarely people that are cutting these positions and just holding cash. That cash is going to get allocated somewhere. And so when you see this negative and then over here, it seems like it could be a transfer. Of course, take what I'm saying with a grain of salt. This could all reverse back on Monday anyways, or maybe it just turns out to be nothing. But this is just something I'm looking at. And regardless of the fact, do I really care that much? No, it's just something I thought I'd throw out, and I noticed. I invest very long term, so regardless if this flips or not, I'm still just looking to pick up really good companies at attractive valuations. So whether this is the start of another rotation of money and then the software companies start to run, we will see. But like I said, I could care less. If it doesn't, better for me, because honestly, I'm trying to pick up more of them at cheaper prices anyways. Now, if we look at another one that I want to point out, because this is one I've been buying heavily over the past couple of months, Zeta up about 3.68%. Now, this one does get lumped in with the SaaS category, and it got kind of pulled down with the whole SaaS pullback. It's more AI marketing, which I don't agree with it getting lumped in with the SaaS, because if anything, more AI actually benefits their business model to like it's a direct benefit. So I'm not sure why it gets lumped in with that. So plus they got a moat that can't really be disrupted by AI. Just the nature of it's a whole thing with their whole with their data cloud and the ZMP, which I have a whole video on that, so I'm not going to go into that right now. But regardless, they benefit a lot from AI, especially with their new product. They just launched Athena, which is their LLM that helps kind of not power their system, but helps kind of amplify their original product that they were already using, and just makes it more efficient and easier to use for their clients that are using it. Anyways, this one 3.68% on the day, so we can see big moves a lot into these more SaaS type names. So this could just be nothing, or this could actually be the start of different investment managers starting to say, okay, let me cut some of my positions. These larger chip names have run up a lot. Like if you look at some of these chip names, they've run so much, so they might be saying, okay, let's try to move on to the next thing, which is how a lot of these investment managers kind of think. Like if you're looking at a Micron year to date, 153%, 660% on the 1 year. Insane. Obviously, everyone's talking about SanDisk, which is always insane. What's it up? Like 3,000% or something on the 1 year? It's something crazy like that. Yeah, 3,300% on the 1 year, which is ridiculous. 492 just year to date. Insane performance from that one. So maybe they're looking to rotate. Maybe it's nothing. Excuse me, I've been getting over a cold recently. But regardless, the way I still look at it is I just look for the stocks that are undervalued, the companies tied to it that I think are great companies that are going to continue to outperform, and I add my positions and I buy those assets for the long term, and I just try to increase my ownership position over time as long as I can, so I can just own a higher and higher percentage of great companies. And just keep doing that, and I think most people will be fine with that strategy. So with that being said, let's go ahead and get on to what I was buying this week. So if y'all have watched my past videos, it's been more of the same, which is why I kind of wanted to change up this video. I still wanted to include my weekly buys, but keep it a little more fresh by including that bit at the start. But I bought 12 shares of SoFi at $16.02, $192 move. SoFi, their earnings was great. They keep attracting new members. I don't think the stock is particularly expensively priced. So I keep adding it. And even myself as someone who uses their product, who didn't think I was going to sign up for their membership, I ended up signing up because they gave me this decent bonus on my interest on the savings. They bumped it up to 4.5% for joining their membership. So I just think as time goes on, if they're able to continue to acquire more and more members and get those members to use more and more products, it's just going to mean they can grab more and more revenue from more and more revenue per user, if that makes sense. So each individual member is going to be worth more in the future because they're going to be using more products. And then with a lot of the newer generation kind of joining the platform, as that new generation builds and builds in their career path, and as they make more money, they're going to be able to use more SoFi's products, whether it be a mortgage or get a car loan from them, maybe run more investing through them. And that's just going to be more fees SoFi's going to be able to collect over time. So this one's just long term. I'm still increasing my position as much as I can. I want to try, and I think my main goal is getting this to around like 500-ish shares, I wanted to say. So I'm going to continue acquiring for a while. Next one, we're talking about this one earlier, which is why I brought it up. I got 12 shares of Zeta also, 1663. I've talked about this one so much. I think I've already made 2 videos on it. I covered the earnings. I did what I thought on their moat. This is probably the company I'm most bullish on in my portfolio. This company is just insane to me. And the fact that the forward PE on this company is sitting at under 20, I think even the forward price to free cash flow, I got to double check, but I'm pretty sure the forward price to free cash flow is sitting under 20. Actually, even if I check right now, what's the current price to free cash flow on Zeta? Let's see real quick. I'm going to pull this up. 24. 24, and just for context, so in the last quarter they just reported, their revenue growth was 50%. Now there was an acquisition, but even excluding the acquisition, 28%. With, I believe the mix was, I believe it was 16% was from same customers, just increasing prices, same customers, or same customer, not just increasing prices, but same customers were using more, so were using more products, so they were charged more. And then I think the additional like 13% was from actual acquisition and new customers. But either way, it was like 28 or 29% organic growth just from the segment, with the remaining growth coming from that Marigold acquisition that took place last year. So the core business is growing really well. The Marigold acquisition added some decent revenue there as well. They have really good net revenue retention. In the past earnings call, they kept highlighting a lot how much Athena was actually improving the amount of products that their clients or their customers were using. And they also highlighted some other figures where as customers are using more and more products, the average spend they have with them and the average amount of wallet share increases at a pretty rapid rate as well. So if you're using more products with them, chances are your wallet spend as a percentage is going to increase with that. So that's why I remain extremely bullish on Zeta. I'm going to keep buying Zeta. Zeta's becoming a pretty big position in my portfolio, but this is one of the ones where this company, I am going to keep growing into a large position just because I actually do believe in the company and the numbers I'm seeing. And so I am perfectly happy making this a larger and larger percentage of my portfolio and just building this as much as I can. I see so many similarities to this one to when I was buying Palantir back in 2022. And I have more money to invest now than I did whenever I was investing in Palantir. So I'm taking advantage of it, and I'm trying to be as aggressive as I can while still being responsible with it, if that makes sense. Now, with that out of the way, let's go ahead and go through some opportunities I'm looking at. So currently I'm looking to add some more positions to my portfolio just to give myself a little more diversification. And also I was just looking at different opportunities I've been seeing that have been kind of downtrending. So we'll start with the first one. We can go ahead and go right here. So Salesforce is one I've been looking at, get a little more software exposure. Currently, my software exposure is mainly, like I said, from Zeta, where they kind of get lumped in that category, as well as I do have a decent sized position in Adobe. So Adobe and Zeta, but I wouldn't mind getting some more software exposure, especially with how much these stocks have been hit. Salesforce, PE on its 19, forward PE of 13. If we go ahead and go into the analyst numbers, let's see. So EPS estimates going out to 2034. They're expecting a CAGR of 15% on the EPS on average. And if we're looking at the revenue, CAGR of 10%, which is pretty decent. So currently they're doing 793 of EPS. By 2034, they're looking at 2429. So Salesforce, nothing much to say here, but it does look attractively priced at this moment. Just PE of 19, forward PE of 13, price to free cash flow under 10. Looks pretty attractive right there. So that's one of the ones I'm considering to get a little more actual software exposure. The other one is ServiceNow, which isn't as cheaply priced, but as we can already see kind of in the forward PE, going from a 55 to a 4 to 22, which means you're probably going to have some crazy extreme earnings growth. So the growth is likely larger on this one. So if we're looking at a CAGR right here on analyst estimates, 27% CAGR to 2032, which is really high. That is actually kind of insane. But regardless, then revenue growth of 15%. So they're expecting some considerable margin lift going into 2032. Next one I've been considering is Celsius. And with all of these companies I'm mentioning right now, I'm not making any decision right now. These are kind of ones I'm looking at. And this weekend I'm going to have some time, so I'm going to go through their earnings. I'm going to go through their annual reports and kind of look through them all and see which ones I like the best based on their current valuation and based on what I find on their earnings and any investor presentations and all the information I can dig up. And then if I start a new position in them, y'all can guarantee that I'll let y'all know which one I did pick to start a new position in. But anyways, Celsius right here. So price to earnings 70, but a forward P of 17. Again, insane margin expansion right there. Going from a 70 to a 17 is crazy. Price to free cash flow of 26. Now, the one thing I like with Celsius, so this one obviously wouldn't give me more software exposure. It gives me more on the consumer side. But the one thing I like with Celsius is just two main things. First off, I don't really have to worry about like with the software where it's like, okay, they got this narrative of AI disruption and everything. Don't have to deal with that with a consumer play. They sell energy drinks. Second thing is the fact that this one's more easy to understand than the other ones, because with Salesforce and ServiceNow, a lot of the reason why I'm gonna have to do some more digging on those is because I haven't really looked into their business models, but just from glancing at it beforehand, it seems a little more on the complicated side or something that takes a little more digging to kind of understand how the business works. This one is more simple. They sell energy drinks. They own the Celsius brand. Now they own Rockstar. They have Alani. They sell energy drinks. I personally try their energy drinks. I do like them. I enjoy them. Again, as someone who takes in a lot of caffeine, but as someone who drinks a lot of caffeine, that stuff is addicting. That stuff sells. It's basically a legal drug. So that's one of the reasons I'm looking at Celsius. I'm like, okay, this could be good. I do like the branding, and I do actually like the product, which helps also where I am investing in a company where the product is actually something I'd go out and buy, which I do every once in a while. I'll get a Celsius. So that's why I'm kind of looking at this. So let's go ahead. We can go and check analyst estimates on this. So if we're looking right now, they're looking at revenue estimates, CAGR of 8.42%, which, okay, 8.42% on the revenue. The CAGR for the EPS is sitting at about 35% going to 2033, which is a decent amount of margin expansion right there. So that's another one I've been looking at. And those are the main ones. Let me make sure I'm not missing anything. Shopify one's one that I've also been looking at, but it's not anywhere near a price I'd want. I guess I can pull up this one. I made a video on this one a couple months back where I've been looking at Dutch Bros. It just hasn't hit the target I wanted, which is a shame. I had a whole video where I did kind of like a valuation. I've been wanting it to get under 40 for me to start a position in it, and it just has not broken down below that 40, but that's fine. There's other names I can allocate my money elsewhere, so it's not the biggest deal. Maybe I'll run my numbers again or take another look at it, but currently it's really, I'd say those three are the main ones. It's ServiceNow, CRM, and it is Celsius are the main ones that I am currently looking at. I am likely going to spend this weekend just going through their reports, going through their latest earnings, and seeing which ones I think are the best. And who knows, maybe I'll buy a mixture of all three. Maybe I'll buy two out of them. Maybe I just buy one out of them. I'd say the most likely outcome is I'll probably pick up two of them, likely, depending on how all my research goes and when I run my DCFs and stuff. I'll likely be picking up, I can already say, Celsius in either the ServiceNow or CRM, one or the other. So like one of the software and then get the consumer name so I can have both of those in the portfolio. But who knows? Maybe I'll look at it and I'll go, you know what? I just want Celsius or I just want this one. I don't need the other ones. I can keep my money more focused over here. Because again, I'm having to allocate and split my money between all these positions because I'm going to still be consistently buying Zeta week after week. SoFi I'll still be buying week after week. Only thing with SoFi, I really like the company, but I don't want to get it to too high an allocation. Multiple things, risk reward on that one. I think the upside on that one could be more limited than with Zeta. I believe Zeta has a higher potential just because of the space it's in, and also Zeta's just at a much lower market cap. It's sitting at like a 4 billion, in the 4 billion range for its market cap, whereas SoFi is what? Is it 10 billion right now? 20. Yeah, just 10 off. Okay, 20 billion. But basically what I'm saying, larger market cap, that's gonna hurt it in terms of gains. And then also just for banks, I'm always a little more cautious on how much I invest in banks. Just reason being is actually from a mistake I made in the past in one of my investments, which I'll go ahead and share with y'all, where I was investing some money in Voyager. Luckily, I didn't have as much money as I have now, so I didn't lose as much. But for anyone who remembers Voyager Digital, that was more of a cryptocurrency play. But they still kind of had their balance sheet laid out like a bank. And they were going ahead and they were reporting a lot of the crypto assets that were actually customers as their own. So it made their balance sheet look a lot stronger than it actually was. So it made it look like the current ratio was higher. And so when I was looking at it, it looked like the company was a lot more liquid in terms of they had a lot more cash than they actually did. So then when that whole like crypto meltdown thing happened, then I believe it was a Threefold Capital? I'm trying to remember. It's been so long now, but whenever that whole debacle happened and they lost their funding, the company went completely bankrupt. Lost all the money in that stock, which is why I'm always a little more cautious on these bank ones, because it is one of those things where it does become a little weird looking at the balance sheet, looking at some of the statements whenever they're mixing, when they mix it like that. To be fair with Voyager, they were from what it seemed like they were actually just misrepresenting what they actually had. And that truly wasn't what they actually had, but they just kind of lied about it on their financials. So not much you can do there, but still, that's just something to where I always have in the back of my head. So when I'm investing in anything like bank or financial related, I'm like, okay, let me limit my exposure and not go too crazy with it. So anyways, that's going to be it for this video. I hope everyone enjoyed and found something useful. And I'm also going to try to have another video out probably sometime this weekend, if not today. But I just kind of wanted to get this one out on the market.